Thank you for joining me today to talk about investing during different election cycles. Today we'll explore how markets are influenced during an election year. With 2024 having so many significant elections globally, understanding these dynamics is crucial for informed investing. Elections are a pivotal time for nations as they shape the future policies that can impact various sectors, including finance, healthcare, and technology. As investors, it's essential to recognize the historical trends and data-driven insights that can help navigate these uncertain times. I'm Deb Klein. I'm a financial advisor at Azzad Asset Management. I work with individuals, families, business owners, and nonprofits across a full array of comprehensive financial areas. Historically, the average S&P 500 return during election years is around 11.5%. Interestingly, 84% of election years since 1926 have seen positive returns. In comparison, non-election years have an average return of 12.4%, with a 70% probability of positive returns. As you can see by the blue bars in this chart, while election years are slightly less favorable than non-election years, the difference is marginal. Investors should note that market performance is influenced by a multitude of factors, and the election year alone is not a decisive predictor of market outcomes. Additionally, the U.S. follows a four-year election cycle, including presidential and midterm elections. Each event within this cycle can influence market behavior differently. Understanding the broader picture of the cycle is more crucial than focusing on a single event. As this chart shows, while the stock market has fluctuated under the leadership of both parties, the S&P 500 has trended upward over the long term, no matter who's in office. The trend suggests that the stock market's performance may have more to do with the overall strength and resiliency of the country rather than who's in the Oval Office. Many successful companies were founded and flourished under various administrations, contributing to the overall economic strength of the country. And why do they flourish? Factors like earnings growth, economic trends, and technological innovations typically influence the market more than political shifts. The most important takeaway from this is that elections often create some short-term uncertainty, so it's best to prepare for some volatility over the next few months. But please do not allow unexpected price swings to influence your overall approach. Additionally, markets tend to perform better in re-election years compared to open election years, with the average outperformance of 5.7%. This trend underscores the importance of economic stability in political and market outcomes. With the incumbent president choosing not to run for re-election late in the cycle this year, we have a somewhat unprecedented situation that leaves us with a little track history to draw lessons from. So, what should investors do? Remember, when you invest in the stock market, you're investing based on your time horizon, risk tolerance, and specific goals, not specific political outcomes. Investors should avoid making portfolio changes based on the emotions and uncertainty surrounding elections. Historical data shows that markets have a remarkable ability to adapt and thrive regardless of which political party is in power. Focus on your long-term investment strategies and avoid knee-jerk reactions to election outcomes. Remember, short-term volatility can present buying opportunities for long-term investors. Maintaining a diversified portfolio and sticking to your investment plan is crucial during these times. In conclusion, while elections create headlines and emotions, their impact on markets is often overstated. Again, staying informed, avoiding emotional investment decisions, and focusing on your long-term goals are the keys to navigating markets in an election year. So how does the election cycle influence the stock market? Long story short, it really doesn't. Thank you for your attention.